Or good afternoon, everyone. We're going to make a start to this,
Good afternoon,
your
sir.
second lecture. And this afternoon, we'll be covering ratio analysis in the first half of the lecture. And then in the final half of the lecture, we'll be covering net present value, the calculation of net present value. Both topics are very important topics to the course of financial management. Ratio analysis is often the first course of action analyst, a manager will take whenever you look at financials or whenever he's attempting to carry out any investigation or preliminary reconnaissance of what the business is like. And then secondly, net present value is a very critical concept to understand in financial management. Essentially what it means is that a dollar today is worth more than a dollar tomorrow. So we'll go through the calculations for that. On the agenda tonight, we have an introduction to financial ratios. And the ratios that we'll cover tonight is not an exhaustive list, but it's a list of the primary financial ratios. Principally, you'll find, if you look into text, you'll find many derivatives of the ratios that we will cover tonight. Some are specific to certain industries, some are specific to certain kinds of businesses. Some businesses may prefer to calculate those ratios or use those formula for particular reasons. But here again, the ones that we will cover tonight are the generally accepted formulas and their calculations. Then we'll work through an example of financial ratios, touching on every class or categorization of ratios or categories of the financial ratios. Then we'll learn how to calculate net present value, and then we'll work through an example. So what is ratios, financial ratios? Essentially, it's a mathematical comparison between figures from 2 years or among figures in a particular year. So it's simple when you look at, let's say, between years, you can compare the movement of revenue in 1 year against the other, or the movement in expenses in 1 year against the other. And when we say within a financial statement, you can do comparisons between revenue and cost, revenue and taxes, those kind of things, right? So year-to-year comparisons are what we call horizontal comparisons, and comparisons between two figures in a financial statement is what we call vertical comparisons. This method of looking at financial statements is the initial step most analysts will take to better understand the strengths and the weaknesses of a financial status of a firm. It sends signals, oftentimes not conclusive, but is an indication of what might be under the surface, and it can instigate further investigation of the numbers. Right? And I say it's not conclusive, but it might just be indicative, because there are smart accountants who might often engage in something that is very topical these days, what we call earnings management. Right? So there are some, and here again is the main uses of financial ratios. So one, they help in decision making and forecasting. I'll go into them a little bit more, but I'll just cover them here. They help in coordination and control of a company. They can be used as leverage to help better the financial position of various stakeholders. You're better able to analyze profits, the origin of those profits, and where those profits are being sucked. It helps you to evaluate financial risk. So if you look a little deeper at decision making and forecasting, how ratio analysis aids that. So one, it can lead to effective solutions. So once you've started to do financial ratios, you will come up with some numbers. And generally there are some benchmark that are out there. So those that benchmarks can be general or they can be specific to a particular industry. So for instance, one of the things that we will cover later today when we work through the example is that you learn that if you're going to look at liquidity, then your current assets should be more than your current liability, right? So if you see that is not happening, then you can dig deeper and you can find what is the root cause for a situation where your current assets can't cover your current liability. And then you can come up with a plan of action to rectify that if it needs rectifying. And I say rectified if it needs rectifying. Again, most of the ratios that you will calculate, or most of the decisions that you make in financial management or even general social sciences as a whole, are context specific. So what is good for one company in a particular context may not be the same for a company in another context. It makes financials more palatable. So when you look at, if you're not from a finance or an accounting background, and if you ever look at financial statements, they can run into lots of pages with lots of numbers, lots of schedules supporting those numbers, and it could be easily lost. But what ratios do is to standardize those numbers in the sense that if we do it vertically, then you can start at the top where you have revenue at 100% and then the various costs as a percentage of revenue being broken down. And you can use that to compare with other companies. So it's a way of standardizing the financial statements by bringing it to ratios and percentages. So it makes understanding the financials a lot better for those who are non-financial. It enhances the understanding of all stakeholders. So once you would have performed ratio analysis, then the various stakeholders could better understand what the financials are really communicating. Right? It is oftentimes the principal communication tool between the company and the various stakeholders. So if, for example, you're a listed company in the US, then you, and maybe most of the major stock exchanges, whether it is in the UK or Japan, you're required to issue quarterly financials. And even in Guyana here, because of, if you're an incorporated company, you're also requested to share with the Guyana Revenue Authority and make quarterly payments. So in some regards, you have some communication with stakeholders, what the position is. So ratios, having done your financials and you look at the news, you'll hear things like earnings per share, dividends per share. Those are the things that you will hear, all ratios, and those are the things that are used as communication tool with the other stakeholders, right? Both external stakeholders and internal stakeholders. So once you know how to interpret ratios, then it would provide a little more clarity on how the business is being run. Again, bringing you back to the example, the liquidity example of current assets, current liability. If you understand and you can correctly interpret that ratio, then it gives you a better understanding of how the business is being run. So for instance, if you would have done the calculation, current assets over current liabilities, right? And you see that your current liabilities are more than your current assets, it might be a signal of, you know, common cash flow problems, you being unable to settle those debts. So it provides some amount of clarity of how the business is being run. These ratios can also be used as a support for future business ventures. In some companies, some middle managers are very ambitious, or even senior managers are more ambitious. In the case, very ambitious. In the case of middle managers, they may take the financials, perform ratio analysis, and say to management, in their case, that's middle managers to senior management, well, here's an opportunity where we have excess cash. Here's an opportunity where we have high liquidity. Here's an opportunity where our debt to equity might be low, so we might be able to borrow to expand business. So they can use ratio analysis as a support for future business ventures, or as I term it here, overtures. Similarly, senior management could use those same ratio analysis to present to a board, for them to undertake some strategic decisions in terms of, expansion, getting loans from the bank, and so forth. So here, ratio analysis is assisting in decision making and forecasting. In terms of coordination and control, the interpretation of ratios can lead to better team coordination, which improves effectiveness and efficiency. When we look at, for another ratio that we'll come to a little later on, that we call the gross margin. So the gross margin will tell you how much revenue you're deriving from the input you make. So it's a comparison between your revenue and your cost of sales. So you'll imagine, and you should recall, that efficiency is a measure of how much output you get from an input. So having and looking at the trend of gross profit margin or gross profit percentage is an indication of how efficient a company is being run, because it says for every dollar of revenue that you get, this is the amount of input that you're making. Or looking another way, for every dollar you spend, this is the output that you're getting in terms of revenue, right? So that is in terms of coordination and control. It's also indicative of how well managers are leading processes in terms of efficiency, again, whether or not there are wastages, in terms of effectiveness, whether or not you're making or meeting the demand of a particular customer. So good communication coordination avoids investment in non-value-added products and aid the control of business. So here again, ratio analysis is being used to assess whether or not an investment is adding value to the company. And remember, the underlying principles or objectives of financial management is to ensure that we undertake business activities that will add value to the company, and thus maximize shareholders' wealth or return. So here, once you would have performed ratio analysis, it could help us to communicate with those internal partners in the business whether or not the things we're doing are adding value, right? Or whether or not we need to take corrective action so that we can better control the processes of the business or the output of the business. Right? Once you would have calculated ratios, then you're able to identify deviations, and these are deviations based on the benchmark you might have set in the company, or based on the trends that you would have had over the years. So once you see deviations, you can take course corrective actions so that it can come in line with what is the wishes, or what are the wishes of the managers, the owners of the business. The other use of ratios as a leverage to another to help better financial, as a leverage to help better the financial positions of various stakeholders. So it can be used as a guide to decide what opportunities to pursue and when, by the use of specific ratios. So when you would have started, let's say for instance, there's an opportunity that you have. Normally in your business plan, you'll do things such as draft financials, and then you run ratios to see what they will look like as one of the analytical actions that you'll take, right? So it helps you to say, once you would have run or ran those ratio analysis, you can say whether or not it is in line with what you're having now. So whether or not it will add value or not. So it is a guide of what you should pursue, when you should pursue, and maybe when you should not pursue them, right? So bringing you back to the example of the managers approaching higher management, or higher management approaching the board. When they would have done their business plan for, let's say, for an opportunity, and they would have done their draft financials, and they would have prepared their ratio analysis, they can use those ratios, if they're favorable, to better argue their positions why the opportunities should be pursued. In the case of employees and labor unions, they can use those as a tool for bargaining employees for better working conditions, emoluments, benefits, and the same for labor unions. They normally use the financials, they run ratios to identify where the stakeholders they represent could be treated better. So there are a couple of types of ratios could also be categorized as long and short, right? So there's some short in our sense here is 0 to 12 months, and the long term is just over a year and going and more. So those ratios can, once you would have calculated these ratios, they can have a significant influence on the policies firms implement, or the strategies that they implement. It helps you establish the source of profits. So in large companies who have the necessary system structure in place, you may be selling thousands of items, and what ratios allow you to do, once you have the system to capture that information, is to even run by products, those, and you can see those which are more profitable than others. You can see which are complementary products, right? Those which are substitute products. So it allows you to do all of that, so you can establish exactly where the profits are coming from, and those also which can tie up your liquidity. So those that are slow moving items or even obsolete items that you have to get rid of. But ratio analysis will do that. In the management of inventory, there's a worksheet that they run based on Pareto's concept of 80-40. So there again, you can look which are the drivers of profits, which are the drivers of costs. So ratios help you to establish a source of profits. Right? It can also identify non-performing projects, departments, or salary. So while my example just now was focused on a particular line of items, ratios can also be done for projects, for various departments in a company, or even for subsidiaries as a whole. Right. You can use it to in the evaluation of financial risk. So in the evaluation of financial risk, you can use ratios to measure sensitivity between a firm's debt and assets, right? So how much debt do you have to incur to, or sorry, how much of an asset do you have to invest in, and how much debt do you have to incur? So if you have to secure an asset, what will be the structure? How much you would get from an equity holder? How much would be financed by debt? And then there's some specific ratios which look at financial risk. Some we call leverage ratios. Any questions? Are there any questions? Comments?
No, sir.
Good evening, sir.
Evening, sir. What time is class actually start?
At 5:15. So classes start at 8:15 on 8:15 on Monday and 5:15 on Thursday. Is it the same that you see
All
on
right.
your time? Is it the same that you see on your timetable? All right. But just remember the class will be recorded. So those who are coming a little late, what you would have missed, you can go back to the recording and catch up. Kenneth, you could go ahead. You have your hands raised.
Yes, good evening, sir. The last part that you spoke about, financial risk could be outlined using specific ratio. You mentioned that you can use the leverage ratio, right?
Yeah.
I'm just clarifying.
Okay. No problem.
Okay, thank you.
All right. So for those who are in my class for the first time, just to let you know, I'm normally very, very punctual and push on with the class. I think it's important that the things that we have set plan to cover for a course that we complete it. So I'll encourage you to be on time. All right. At the end of the day, or at the end of the course, it's my sincere wish that you would have left covering everything that we're scheduled to cover, and two, learning exactly what we were supposed to cover. Right?
Sir, good evening. Ravindra Puran here. I had a bit of problem earlier. But I'm thinking about the timing, sir, the timing of the class, because from the time we leave work and come home, I'm talking for working people. There is no way that we could catch the 5:30 class. In the morning now, because of work, we cannot attend the morning class.
Right. Ravindra, I mean, I know for some people it would be a challenge, um, but for me to push it back is a little tough on me too. It's very tough to
So I
push it
agree with
back
the same
later.
sentiments with my colleague. I think that is a very important point because transportation, and then you got the COVID, and then GT&T, the issues with GT&T and GPL. It's very difficult for us to get home to attend class at 5:15. So I would share the same sentiment that my colleague would have just mentioned.
But when we said get home, where you getting home from? Exactly where? So you work in town, you got to get to where?
For me, sir,
Gotta get
for me, I am living up in Enmore, sir.
Uh,
So if I leave work 4:30, there is no way I could meet home for 5:15.
so isn't there no chance of working out to the employee? I mean, it's, well, I don't know how many classes you have. No, but is there no way you can work going until earlier so that you can meet maybe 4?
No, sir, the kind of job I am doing, it's not possible, sir. But I mean, I'm speaking on behalf of myself. If that would throw you out, well, then I don't know. I guess I'll have to miss an hour or 45 minutes class every time I come.
Right. I mean,
Very sad.
so what happened? So what happened when we met? What happened when we met in person and classes with 5:30, 5:15 at UG? Was it still a struggle?
No, sir. From work to UG was no distance, sir.
Because at
Was
that
a lot
point the
easier.
employers were aware that we have a online. I think the employers are of the view that online means it would be that UG would have put into consideration the pandemic and after 4:30. But if it's in class UG, they give the exception that you have to physically go in there. I think they kind of flex with the online classes. Their claim is that it's online, UG should make preparation for you guys. You have, so that's where the issue comes in.
All right.
Exactly.
Right. So I mean, it's a little tough, and I know it's COVID. I'll try to make it as easy as possible by recording. But I mean, honestly, I got other stuff that I do. So I'll give you an example. Like this afternoon, so I'm also the president of the QCO Students Association. So I've said to them, no, I'm not attending this afternoon's meeting. Right. So I'm also giving up some things, but I trust, or I'll try for those who might be a little late, that the stuff that I do early in the class is not um, too difficult, so that when you go and you look at the recordings, then you should be able to catch up. If you're not able to, then there are a couple of options. You could always shoot me an email. I generally respond in decent time, within an hour. Uh, Secondly, I'll bring this question to the class now. Do you think you need a tutorial class?
For me,
Yes.
yes,
Yes,
sir.
sir.
The
Yes,
question,
sir.
sir?
Sir, the first thing in the tutorial is that we have, even if we are allowed a tutorial, what are the timings that are available? Because even if you offer a tutorial, there may be another issue of timings, and there's
I
where
think so. The tutorial class will be on Saturday, I think from 2 or 12 sometime then.
What about the Adventist, sir?
Well, that's the thing. So
Tutorial
then,
is definitely needed, sir.
so then,
yes,
then you just have to come to class. I mean, then what they do it on Sunday then, and then some people will go to church on Sunday. So I'm also aware that, so this class has close to 300 people. So I know it will be hard for everyone to fit in with everything, as much as I try, or as much as the administration of UG tries. You'll see they probably have about 5 versions of timetable already. Right. So the options are, the options as I see right now is Monday morning, Thursday afternoon. I have to respond to them by tomorrow to see whether or not I want a tutor to take the tutorials. So I'll say to them yes, but it will be on Saturdays. So you have Monday, Thursday, repeat the tutorials on Sunday, and then you can on Saturday, and then you can look at the videos. So you have 4 options. I mean, so university life and working requires some amount of sacrifice and hopefully flexibility by an employer. And trust me, I've been in your position too. I've always worked and studied, always. Right? So see, August, you could probably be nice with your employer, and there's some good ones out there. With any more concerns?
I think, sir, if you have a tutorial, I'll be happy. So even if I am late for the Thursday class, I guess the tutorial should be able to help me a bit.
I could tell you, I wouldn't be taking the tutorial class though.
Okay. And you
Yeah.
said you have a YouTube channel, sir, that we could go and review back these.
Yes, go on YouTube, look up my name. At the end of tonight's lecture, once I get back from Zoom, a copy of the lecture, then I load it up to my YouTube channel so that you can look at it.
All right, thanks.
All right, so there's options. I mean, I'll try my utmost best to ensure that at least you have access to the information, even if you're late. Right. All right, so let's move on. So types of ratios, there's short-term ratios, which we otherwise call solvency or liquidity ratios. There's long-term solvency or what we call financial leverage ratios. Short-term, you would imagine, is 0 to 12 months. Long-term is 12 months and over. Their asset management or turnover ratios, profitability ratios, market value or market prospects ratios. These 5 categories or types of ratios are highlighted here. And if you look at certain, in some text, you'll find it slightly different. But the thing about it is just understand the essence of what they're saying. Typically in academia, everybody wants to give something a name, and they principally want to say why their name is the better. So there's always a tug of war in academia, right? So some of the ratios, short-term solvency or liquidity ratios are sometimes referred to as liquidity measures, and it's primarily focused on the ability of a firm. It is primarily focused on the ability of a firm to settle its debts over the short run without undue stress. Importantly, without undue stress, because one example of undue stress is where companies have to give deep discounts to ensure that they can have a sale. So for instance, if debts are becoming due, companies might have to cut their selling price so that they can garner that revenue to settle those debts, right? The emphasis is on current assets and current liabilities. So the first ratio is the current ratio, which is current assets divided by current liabilities. And essentially what this ratio says is how much of current assets we have to cover our current liabilities. If you look close at this ratio, it resembles or it has the same components of working capital, except that working capital is current assets minus current liabilities. But they generally are focused on the same objective, and that's whether or not a company can meet its current liabilities. Then there's and in the current assets, you might recall it will, from the financials or the abridged financials that I shared in the first lecture, current assets will include things like cash, debtors, prepayments, inventory. Of this current ratio, there is a derivative of it, which we call the quick ratio or the asset test ratio. And what this ratio, the calculation of this ratio is done by taking current assets, lessing inventory, and then divided by current liabilities. The thinking behind this ratio is that inventory, though classified as current ratio, is not something that you can easily sell, right? So they're saying, look, our true measure of liquidity are the other assets, debtors, cash, prepayments, because we can realize benefits from that sooner than inventory. Included in inventory might be things such as obsolete inventory, which is of no use, damaged inventory, slow moving inventory. So that's the premise on which this particular ratio is built on, but it gives you a better look of what your liquidity position is. Then there's a cash ratio, and the cash ratio takes it a little deeper by saying, without selling anything, this is the cash that I have available to cover my current liabilities, right? So these 3 ratios are the principal ratios which you have or which we call short-term solvency or liquidity ratios. There are many derivatives of them. Of course, as I pointed out, most academics want their piece of fame. In a general sense, you would want, in every case, be able to cover your current liabilities, right? There are some exceptions. Let's say, for example, there are some companies that go on just-in-time inventory methodologies or approaches that they have. So their current assets might only be constituted of cash and debtors and so forth. But what it says is that in those cases, you might have a situation where the current assets might be less than the current liability. And while in a general sense, that might be indicative of an unfavorable position, in that particular case, if you're running a business on a just-in-time basis, it might not be that alarming. So again, once you have done those ratios and you've seen the results of those ratios, you use those results and then you do a deeper dive into the company's operations to understand whether or not the ratios you are calculating are good or bad. In a general sense, though, you would like your current assets to cover your current liability. So every time you do the calculation, it should be, something in excess of 1, right? Any questions, comments, clarifications?
Sir, I haven't noticed this slide posted.
You haven't noticed it posted? Where did you check? Did you check Edmodo?
Yes, sir.
Well, it's right there. It's been posted since Sunday or Monday morning. It's right there. I should also tell you by the next lecture, I now have access to Moodle and it's populated with the course that I'm teaching. So I'll be shifting everything to Moodle. All right, so all the slides and readings and announcements and everything would be on Moodle. And I will stop using Edmodo. So please share it with your friends. But I endeavor to share the slides, the lecture slides, before Monday morning. So if you haven't seen it on Edmodo, just take a closer look and it's right here. Any questions on the liquidity ratios? Any clarifications?
Sir, excuse me.
Yes, go ahead. Yes,
sir,
go ahead.
Can you elaborate some more on the cash ratio?
On the cash ratio, essentially what it looks at is whether or not the cash you have on hand, cash on bank, is able to cover the current liabilities. So while we say, because cash is the most liquid of all the assets you have, right? I mean, you have it, you have the cash, you have the cash. There's nothing else you have to do. You can just issue checks, make bank transfers, and settle those liabilities. Whereas when you have debtors and you have inventory, it takes some amount of effort in the case of debtors to get them to pay, right? And in the case of inventory, it takes some amount of effort to get them sell. Some you may sell cash on a cash basis, so you have cash. Some you may sell on a credit basis, so that inventory goes from inventory to debtors, and then you have to take some time before you get the cash. So here the cash ratio says, look, this is what we have without doing anything. And then, it's a measure of whether or not that cash could cover your current liabilities.
And with any business, or this is used to show like, should I invest on a short term or long term?
No. So liquidity ratios has nothing to do with investments. Liquidity ratios emphasis is on whether the current assets you have could cover the current liabilities that that you have, right? So whether the current things that you own could cover the current things that you owe. So within another 12-month period, whether you could garner or you can collect enough cash to pay those debts that are becoming due in that 12-month period. So it has nothing to do with investment.
Okay, so if I understand, it basically tells me whether my business stands a chance of continuing.
Right. So it's
The
an
liquidity
these
ratio.
ratios are more of an operational aspect.
Okay,
It looks at operations, right?
okay.
Yeah.
All right,
Good
sir. Thank
question.
you.
Excellent question. Because it brought out something that I didn't mention, right? So these ratios focus on the operational aspect of a company. Good. So you see, that's why I gotta ask the questions, because you get more out of it. And there are no silly questions.
Excuse me, sir, when would we use which ratio to find out what?
Well, generally, when you are doing an analysis of a firm or you're doing a review of a firm. So if you're an external, let's say you're a lender. So you're a bank, you ask a company to bring their financials. You run everything. You want to see. So generally, they run all the categories of ratios, right? So banks will do it. Management should do it. So you have, your monthly management meeting. You want to look at those things. Um, so they generally run all those the different categories of ratios. But of course, some ratios will be more of interest to some people. So the persons on the operational floor, the credit controllers, they would be more concerned about these ratios that we just covered. Bankers would look at these ratios, and in addition to these, some ones we will cover a little later. Uh, Persons running investments in new ventures in the company, they will also look at some other um, ratios that we will also cover, right? So let's take, for now, these liquidity ratios are of greater concern to the people who are involved in operations management, right? Does that answer your question? All right. So there are two ways to express the current ratio. So we express it either as a dollar or times. So once you would have executed the calculations of current assets to current liabilities, you will have something that says, like for every $1.50 of current assets, you have $1 liability. So take, for example, we have $1,500 in current assets and $1,000 in current liabilities. So it's current assets of 1,500 divided by current liabilities of 1,000. That'll give you $1.50. So you'll say for every dollar of current liability, you have $1.50 of current assets. Or alternatively, you can say your current assets cover current liabilities 1.5 times. So if you're going to write a statement, you've done the calculation and you're going to include it in a report, these are the two ways that you can say it, or you can communicate it. Right. So a high current ratio may be indicative of high liquidity, meaning that you have lots of excess cash in your business, but it might also be indicative of the inefficient use of cash. So in the case on other short-term assets. So in the case of you having a high liquidity, it might be saying, so you have lots of cash that is not being invested, right? So it's sitting in the bank. Currently now in Guyana, I think all the banks pay less than 1% interest. So you just have the money there, earning less than 1% interest. When you can invest in a project, even if it earns 5% interest, you'll still be better off. It's still a more efficient way of managing the resources that you have. So here again, this is where context is context and understanding the whole picture of the business is important. So instead of, some companies may elect to, and this is if cash flow allows, to say, look, we're not going to carry a high cash value, which means the chances of current assets being more than current liabilities decreases, right? So you might run your calculations and realize that you only have 90 cents of assets for every dollar of current liability, right? But that might be offset by the investments that you make and the cash flows when those cash flows are made. Just remember that when we do these ratio analysis, we do them at a particular point in time, right? So this might not be indicative of what is actually happening now. It might be indicative of something that happened 2 weeks ago or last month. So those are things that we must bear in mind. So we might be looking at last month figures, do the calculations, and we see that we're less than we're 90 cents of current assets, a dollar of current liabilities at last month end. But having invested that excess cash, we might be having those returns coming this month and in time to settle those liabilities. So it might not be as damning as we think it was when we've done those calculations. That's why I said from the outset of the class that ratios are just a preliminary, cursory look at companies. It's sending in a direction to better understand how the company is performing, but it's not the end it all of the performance of a company, right? So I just want to make that very, very clear. This is just one aspect in the analysis, right? Some may say it's a quantitative aspect of it. Then you do the deeper dive of understanding the qualitative aspects of it, understanding the context, making the connections to better understand if the ratios are good or bad, and if they appear bad, if they're being offset by other situations in the company. The quick ratio, we exclude inventory for the reasons stated before. Some might be slow moving, damaged, or obsolete, which affects liquidity. So it might give you a false sense, or the argument for the use of this ratio is that having slow moving, damaged, or obsolete inventory items gives you a false sense of liquidity. So those who come from the accounting background will know that if we have these things, then you might have to make adjustments to inventory, since inventory might not be actually stated at net realizable value, right? So to ease that headache, or to get rid of that headache, or that concern, sorry, the quick ratio eliminates inventory, right? A relatively large inventory is a sign of trouble, which is induced by overestimation of sales, which could result in overbuying or overproduction, right? So although your ratio, if you have, as we did in the current ratio, if we include inventory to make you look good in terms of the relationship with current liabilities, but having large inventory is also a signal of things that are not good, right? Because again, it could be an overestimation of the things you expect to sell, so you end up buying more and it's left in your hands. Or if you're a manufacturing company, you would have manufactured more than you've actually sold or expect to sell. So we go to long-term solvency, or what we call financial leverage ratios. Sometimes they just refer to financial leverage or just leverage ratios. And they focus more now on the firm's ability to meet its long-term obligations. So short-term solvency ratios look at 0 to 12. Financial leverage ratios look at the firm's ability to meet long-term obligations. Some long-term obligations will include things such as bonds, right? Multiple year bonds, and also things such as loans. So the principal ratio in this category of ratios are, total debt ratio. So the total debt ratio, you look at total assets minus total liabilities upon total assets. Right? That's the total debt ratio. Then there's a time interest earned ratio, which is earnings before interest and tax divided by interest. And this ratio essentially looks at how much profit you would have earned to cover the interest that you owe or you would have paid. And then there's a cash coverage ratio, which is the earnings before interest and tax plus depreciation divided by interest. This ratio tries to, as much as possible, to derive the actual cash that you would have gotten from operations, right? It's an attempt, but not a strong attempt as it should be, because here you're looking for, you're using profits, which has some amount of accrual accounting in it, and you're dividing it by interest. It's an attempt to understand the cash that originates from operations, but it's not, the answer or the numerator is not exactly the cash that you have from operations, but it's an approximation. But here it looks at, again, how much of the interest you can cover. If I can go back to the total debt ratio, it says, this one here says exactly how much debt you have to equity, right? So in your capital structure, it will say for every dollar you have in capital, so much is made up of debt and so much is made up of equity. So that's the debt, total debt ratio, okay? And just a general question, when we look at, if we have a dollar, some of which is made up of debt and some of which is made up of equity, what do we call it?
Capital
Any
structure.
takers? All right, correct. That is a capital structure. So always remember, the capital structure is constituted of two main things, debt and equity, right? So the first formula tries to tell you in your capital structure, how much of it is made up of debt. And of course, the remainder would be equity. So just remember that every topic, they have some amount of connections. So once you could start making those connections between the different lectures, then you know you're on the correct path. Are there any questions, comments?
Yes, sir.
Go ahead.
Okay, so there's the debt ratio, which is total liability divided by total asset. Is it the same as the total debt ratio, or it tells a different story?
You're talking about the first one, right? It
Yes,
says total assets minus total liabilities
total
divided by
equity.
total assets, right?
Mhm.
So what it, and you will see when we work through the example, what it is trying to tell you, or what it's trying to work out, is in your capital structure, how much of it is debt, right?
Oh,
So you see, if you recall on the example that I share of the balance sheet in the first lecture, you had assets on the left, liabilities and equity on the right. So you have total assets, you're lessing, if you less total equity, then what is left is just debt, which is creditors, loans falling within 1 year and so forth, right? So essentially what it's saying is debt upon total assets, right? So you want to know how much of that debt is in your structure, makes up your capital structure.
Okay, so
Right?
if
That's all
I
it's asking.
okay, so if I have, let's say I have a business, and over the past 4 years, when I did the ratio, I got like 0.57, 0.56, 0.53, and 0.45. Is it telling me that my debt is decreasing?
Well, if everything else remains the same, then yes,
Okay.
right? Because remember, businesses have different um, aspects moving, right? So you could, in that case, you could have issued more equity,
Okay,
right?
okay, okay.
So then, of course, as when compared to debt, of course, right? So your equity could have grown fast, or sorry, right? Your equity could have grown faster than, or sorry, equity financing could have grown faster than the debt financing. So
Okay.
in relative terms, then your debt ratio would have been decreasing, sorry, right? So that's one way. Or you could have kept your equity financing constant and be paying off your debt. So you know, well, yeah, it's a real reduction in your debt, right? So that's one way you could among
Okay.
others, but
Okay.
that's a
So
too easier one.
okay.
And
So
then of
this
course there's some times that you will there are benefits for carrying debt because government might have particular programs in place, right? So I can give you an example now. So at the last, at the pass of the last budget, the emergency budget, the government took a decision for those who take loans to purchase property that is under 30 million, you get back the loan interest, right? So you imagine if I'm a sole trader, then if I know I get back the loan interest, if I was supposed to borrow, you know, 20 million, then I might be now encouraged to borrow 30 million because I know basically what I'm paying back is just the capital because government giving me back the mortgage interest. So that will also influence whether or not I take more debt, right? So that's just an example. So there are many other things that are at play, right? So you might look at a company and see that a sole trader and see that his debt ratio went up. But his debt ratio went up because there's no a tax incentive given by the government where I get back all the interest that I pay on the particular loan, mortgage. So, right. So those are things that will not come out in the calculations, but those are the qualitative things that you need to know whenever you do reports on ratios, right? Any questions? All right, let's move on. So the total debt ratio takes into account all debts, all maturities to all creditors. So these are both long-term, short-term creditors, and is expressed as a percentage of debt used by the company. There are a couple of variations of the total debt ratio. We have debt to equity, which looks at total debt upon total equity. Then you have the equity multiplier, which basically says for every dollar of equity invested, this is the amount of asset that you'll derive. And of course, if you have any of the three, you can immediately calculate um, the other two, and it essentially says the same. Right? The time interest earned measures how well a company has its interest obligations earned. the cash coverage. This is a ratio we try to, as I explained earlier, try to arrive at your operating cash flow amount. And again, it says how much cash is available to pay the interest. Right? So the first one, the times interest earned, basically looks at the profits that are available to cover your interest, and the cash coverage looks at the amount of cash that you have to cover the interest. Right? So the times interest looks at the profits that you have to cover the interest, and the cash coverage looks at the cash that you have to cover the interest. And you'll agree that profits and cash are not the same. There's also the asset management or turnover ratios. These are sometimes referred to as the asset utilization ratio, and they measure a firm's efficient use of assets to generate sales. So it essentially says for every dollar of asset that I have, what is the amount of sales that I've generated? Right? So first, there's the inventory turnover, which is calculated as the cost of goods sold upon inventory. Right? So how much time the inventory that you've invested in a year is turning over, how many times, and then you have the days sales in inventory. So here you take the inventory turnover divided by 365 days, and it essentially says this is the amount of days that my total inventory will take to sell out, and then I replenish and take to sell out, right? In layman's term. Receivables turnover, here you look at sales divided by accounts receivable, and here you see, here it principally says the amount of time in a year that your accounts receivable will replenish and we repay it, replenish and we repay it. And then the days sales in receivables basically says the amount of days you take to collect your receivables. So the last one question, days sales and receivables, what will be the ideal thing? If we have 60 days and 35 days, which is better? 60 days or 35 days, as in days sales and receivables?
$35.
And why would you say 35?
Because you're taking a shorter time to sell your stocks.
Or to receive the money from the debtors, right?
Yeah.
Right. The same thing is also true for the sales and inventory. You want the inventory to be turning over lots of time in the year. So you want that days to remain low, right? Total assets turnover is sales upon total assets. So you basically say how much the investment in total assets, how much sales it's deriving, right? So if you invest 1,000 in assets, then hopefully you'd want sales to be more than 1,000, right? So it measures every dollar of asset invested, how much sales is derived. So that's a total asset turnover. The capital intensity ratio is the reverse of the total asset, or sorry, right? The converse of the total asset turnover. So here it's the total assets divided by sales. So it says for every dollar of sale, how much in fixed assets, how much in assets do I need to invest, right? So how much in assets do I need to invest to get $1 of sale is the capital intensity ratio. The total asset turnover now is how much sale do I derive from an investment of $1 in assets. Then similarly, there's the payables turnover, which is cost of sales upon accounts payable. Right? So generally, what do you want this figure to be? How many times do you want to turn over payables in a year? Lots of times or a few times? Any takers? Payables turnover now. So there's a case of where you owing people. Or let's look at the related one, days costs and payables, which is the number of days in a year divided by payables turnover. Do you want this to be 60 days or 35 days? Which is better for you looking from your perspective? So you're the owing party. Of 126 people online, one person can't give me an answer, or at least volunteer. There are no wrong answers, so.
Sir, 60 days.
60, sir.
30 days, sir.
60 days.
All right, so I'll go with
It will
60
take
days
me my sales
because.
for 35 days, so I will have to get that first.
So I'll
Sir,
go with
prepare
60
with
days.
30 days.
Right. I'll go with 60 days principally in financial management. This is what you want. You want to get pay as early as is possible by the people who owe you, and you want to pay as late as possible the people you owe. Of course, without incurring any penalties, and those penalties could be both financial or, I mean, to your reputation, right? If you get a reputation as a bad payer, then next time you come to buy, you might say, oh, you need to buy in cash, right? So while we say 60 days, we say 60 days with a caveat. Once it doesn't damage the relationship we have with that particular supplier, or we don't incur any, reputational damage, or you have any extra interest to pay because you paid late. In that case, you pay attention to your terms of payment. So yeah, but ideally, just to repeat, in financial management, when people owe you, you want to collect your money as soon as possible. And when you owe people, you want to pay them as late as possible, right? So that's bear that in mind. The main profitability ratios, they're intended to measure how efficiently a firm uses its assets and how efficiently the firm manages its operations. The focus here is on net income. So we look at the profit margin, which is net income upon sales. We have the return on assets. So here we look at net income upon total assets. So for every dollar of asset that we have, how much net income we're deriving, right? You have return on equity. Here we look at for every dollar of equity that we have, how much of net income we're achieving. Any questions on profitability ratios? This seems to be a simple category, right? So not much explanation required for this one. I got some feedback. Are we comfortable with the profitability ratios?
Yes, sir.
All right. And Avi, you speak for everyone, right? Or are you speaking for yourself, Avi?
Just for myself, sir.
Sir, I'm okay with.
I'm okay
Could you
with
repeat
it, sir.
that? Okay, great.
Sir, can you please repeat what is a capital intensity ratio? I didn't get to hear that one.
Right. So the capital intensity ratio is a measure, right, of how much assets you need to get $1 of sale. Right?
Okay, sir. Thank you.
You're welcome. Right, so the final category of ratios are the market value or market prospects ratios. These are obviously applicable to publicly traded companies because, of course, these ratios include market information. But this does not, so if you're not a public traded company, but you want to work out similar ratios to this, what might be one of the approaches? And that's a question to the class, right? So we said the market value or prospect ratios are for publicly traded companies. But let's say you're a private company and you want to work out similar ratios. What might be one of the approaches?
Can you repeat that, sir?
Right, so we're saying that the market value ratios are for publicly traded companies, right? Because most of the market value ratios include things such as share value. So there's share value out there. So we know those shares are being traded fairly often, or there's an active market for those shares. So we can know the share price. But let's say you're a private company, you want to work on these similar ratios. What might be an approach? All right, so I'll answer. So one possible approach is to look for a company that is of similar size in the same industry, has similar features, characteristics of one that is a traded company, and then you can use that as a proxy. Right, so that's one way of carrying out those calculations despite not being a publicly traded company. You understand?
Yes, sir.
Right, so you look for, so although you're a private company, you look on the stock market, you can look at a company that has similar revenue to you, similar capital structure, probably the same industry, and then you said, all right, I'm close to this company, then maybe I can use their public figures. It's just a proxy, it's just an approximation of, for you to carry out some amount of analysis. All right. So the first ratio that you will hear a lot of is earnings per share. So earnings per share is the net income divided by shares outstanding. So the shares, so when a company is formed or incorporated, they will have an authorized share capital. So for instance, the authorized share capital could be 1,000 shares. Right? Depending on the demand for cash flows, the company can issue all 1,000 shares, or they can issue some and keep the others. Right? So the shares that they actually issue is the outstanding shares, or the shares in circulation at the end of that particular period is the outstanding shares. Because you'll also appreciate that some companies have and those who might have excess fund, cash could do things such as share purchase. So the amount of shares that is outstanding or that is in circulation at a particular period is what we call outstanding shares. So the shares that is in circulation at the particular period is the shares outstanding, right? Then there's a price earnings ratio. Here you take so the first ratio, you don't get anything. This doesn't include any market information. This is all comes from the income statement. So you'll get the net income from the income statement, and from the balance sheet, it will tell you share capital of so many shares, and you will see the outstanding shares there. So that comes from the balance sheet. And then there's the, are you still seeing my screen? Hello?
Yes, sir.
Yes, sir.
Yes, sir. Yes, sir.
Signal, but it's frozen.
I'm not seeing it now. I'm not seeing mine. It's gone dark. Is it moving?
No, sir.
No, sir.
Yeah, no.
All right. And I'm still not seeing anything. Anyway, the next one is the, what I want to say, the price earnings ratio.
Yes.
So the
Yes,
price
sir.
earnings ratio is, okay, so now it's back. I don't know what happened, right? So the price earnings ratio is the market price of that share at that particular time that you're doing the analysis, and you divide it by earnings per share, right? So this basically says, for every dollar that this share has earned, so it gives you an indication of the premium that the market is placing on the shares, on the earning of every share, earning of every share, right? So if you have a dollar, so let's say the earnings per share was, for simplicity's sake, $1, but the market is valuing this share at $10. So it basically says that for every dollar share that you earn, we think this share is worth $10. So it's, in a sense, it's a premium that the market places on that particular share, right? Or the earning ability of that particular share, or the earning performance of that particular share. Then there's the price shares ratio. So this basically says the price per share divided by sales per share. So sales per share is the top line figure, what we sometimes call revenue, divided by the number of shares that is outstanding, or the number of shares that is in circulation. Then there's the market.
Price shares ratio.
Go that again.
Please explain price shares ratio once more.
Right. So the price shares ratio, you get the price per share from the market, and then you have the sales per share, right? So you take revenue divided by the number of outstanding shares, right? And you get the denominator. So it says that for every share, whatever it earns, this is the premium that the market is placing on it, right?
Gotcha. So
the only difference between the earnings per share and the sales per share is that earnings per share takes into account profits. The sales, the price shares take into account revenue, right? And then there's a market to book ratio, where you take the market value of the shares, which is the share price that you have at a particular time, and you divide that by the book value per share. So the book value per share is the historical value that you have for the share, and it's just a sense of the appreciation and value that the share has had at that particular point in time. So while you might have bought the share for $10 a share, the market value could have gone to $15, right? So that is the capital appreciation of that particular share. So that's what this ratio looks at. Then there's the enterprise value. So this is total market value of, sorry for using these words interchangeably, but stocks and shares are the same thing. They're used interchangeably in here. So it's a total market value of stock plus the book value of all liabilities minus cash. So these give you a sense of the operating value of the company, right? The enterprise value. So here they give you an idea of the operating value or operating assets of the company, right? That's the enterprise value. So remember, this one here is total market value of stock plus book value of liabilities. And they've used the book value of liabilities because the thinking behind this is that the book value of liabilities are oftentimes very, very similar to what the market value of that liability is. So there's no need to do that extra work to get the market value of that particular liability. And then there's the EBITDA ratio, which takes the enterprise value and divide it by the earnings before interest, tax, depreciation, and amortization. Right? This value is similar in spirit to the price earnings ratio, but it relates to the value of all the operating assets of the enterprise to measure the operating cash flow generated by those assets. Right? So the enterprise value here is an approximation of the value of the operating assets in a company. The ratio at the bottom, the EBITDA ratio, looks at the operating assets of the company divided by the amount of operating, and this is close to operating cash flow, because if you remember in the cash flow statement that we did last week, we took the earnings before interest and tax, we added back depreciation, which is for, and depreciation is for tangible assets, and amortization is for intangible assets, right? So we're saying the operating assets of a company, the value of the operating assets of a company divided by the operating cash flow of a company. That will give you the EBITDA ratio, right? So it's saying for every dollar of operating cash flow, this is the value of operating assets that we need to have on board, or the operating assets that we have on board. Any questions? Again, when we work through the example, we would be, it will clarify and some more things. So now we're gonna take, we could take 10 minutes, during which time you should take a look at the questions. When we come back, we will go through that question and then we go to the other half. So 10 minutes, we start back at 10 to 7.
No, you didn't.
Okay, we're back. So let's work through the first question on the worksheet. So A, we asked to calculate the current ratio. And we're looking at 2016 figures, right? So below are the recent abridged financial statements from Wild Hack. Use them to calculate the ratios for 2016, which follows. So 2016, what would be the current ratio be? And where would we pick up the numbers? Would that come from the income statement or the balance sheet?
Balance sheet.
And the formula for current ratio is?
Current assets divided by current liability.
Right. And the current assets for 2016 would be?
648.
Right, so the 648 is the total of cash of 88, accounts receivable of 192, and inventory of 368. Does anyone have a question of where the 648 came from as total current assets? Is everyone comfortable with where it came from?
Yes, sir.
Okay. And then, so that's the numerator. How much do we have for current liabilities?
1183.
Right. 1183. Good. So the answer for that would be how much?
0.55 or 0.54.
So that's 648 divided by 1183. Everyone okay with that answer? So that'll be expressed as 0.55 times. B, the quick ratio. To recap, what is the formula for the quick ratio?
Current assets minus inventory divided by current liability.
All right, that's correct. So the numerator would be
648 minus 368 divided by 1138.
Right.
3.
That's correct. Does anybody have any difficulty with this particular formula? The quick ratio. So just to recap, the quick ratio, the formula for the quick ratio is current assets minus inventory divided by current liabilities. In this case, it's total current assets of 648 minus inventory of 368 divided by total current liabilities of 1,183. Does anyone have any questions, concerns? Where the figures come from?
No, sir.
In both, so the answer for the B would be 0.24 times. So in both questions, we have current assets being less than current liabilities. So both formulas, we're saying that our current assets or our current assets liability cannot cover current, sorry. In both ratios, we're saying that in the first one, in the current ratio, we're saying our current assets is only 0.5 times. So for 0.55 times, so for every dollar of current liabilities, we only have 55 cents of current assets. And in the current ratio, we're saying for every dollar of current liabilities, we only have 24 cents. What would be an initial reaction to this, to the answers of these two ratios? Is it a good thing, bad thing? If it's good or bad, why it is?
Sir, it's a bad thing because you have more expense than what you actually have in hand.
Right. Or what you said is a bad thing in the conventional cases, right? But of course, there's some unconventional cases. So you dig deeper to understand whether or not it's a good thing or a bad thing. So remember, the ratio is only indicative; it's not conclusive, right?
Excuse me, sir. Could you confirm the current ratio?
What do you want me to confirm? The figures, the formula?
Sir, you're saying that the current asset is 0.55 times it's able to cover the liability?
I'm saying that for for the current ratio, it works out to 0.55 times. So I'm saying for every dollar of current liability, for every dollar, you have 55 cents of current assets. So certainly it can't cover the current liabilities. Right, Talita?
Thank you, sir.
Okay. So we can move on to the cash ratio. So the formula for the cash ratio is cash upon current liabilities. Again, we get those figures from the balance sheet. So cash should be $88 divided by current liabilities, total current liabilities of 1,183. And that'll give you an answer of 0.07 times. So every dollar of current liabilities, you have 7 cents of cash. So again, I remind you, these are just the initial analysis. You dig deeper before you can come and conclusively say whether or not the ratio signal bad things or if it's acceptable in this line of business is in this particular context.
Sir, excuse me, this balance sheet, you send it through on Edmodo?
All of these things have been loaded since Sunday. As I promised since last week. Yeah, as I promised since last week, and I'll repeat again, everything will be loaded before the first class on Monday. When I migrate everything to Moodle, it will be the same approach. So if you check Sunday or latest Monday morning, but certainly before Monday morning class, all of these things would be loaded. All right. So D, inventory turnover. which is cost of goods sold upon inventory. So where are we getting the figures from now for inventory turnover? Where do we get cost of goods sold?
Income statement.
Where do we get cost of goods sold?
Income statement.
And income statement.
Okay. And then we get inventory from the balance sheet, right? So inventory turnover would be how much? How much is cost of sales, the numerator?
$24.53.
Correct. And then inventory, the denominator would be?
368.
Okay, good, correct. So inventory turnover would be how much? 2453 divided by 368.
2085.
It's 2453 divided by 368, sorry.
6.7.
7.
And that's 6.7 times, right? Turnover is measured in times. Then we're asked to, any questions on inventory turnover? So it's saying, what this ratio is saying is that inventory that you buy will turn over 6.7 times in the year. Any questions?
No, sir.
Then we have the next one is receivables days turnover. So that's sales upon accounts receivable. And sales you get from the income statement. So that's 3,756. And then accounts receivable you get from the income statement, which is 192. And the answer you should get is 19.6 times.
Right.
We're then asked at F to calculate the days sales in inventory. And the days sales in inventory is the number of days in a year. So that's 365 divided by inventory turnover. So we have calculated inventory turnover before. Inventory turnover was 6.7. So days sales in inventory would be 365 days in a year divided by 6.7 times.
54.
So that'll be 54.5 days. So 54.5 days is the amount of days that the inventory will take to sell out, and then you replenish it. It's not absolute, right? So that's the average days that it will take. Yes, you can say 54.7 days. Then we're asked at F to sorry, at G, days sales in receivables or receivable days. Which is the number of days in a year divided by the receivables turnover. We've already calculated the receivables turnover at 19.6 times. So the sales and receivables would be the number of days in a year, that's 365 days, divided by receivables turnover of 19.6 times. So you'll end up with 18.6 days. So that's the days, the amount of days that the people take on average to pay you. Any questions, comments, clarifications? All right, moving on to H. So total debt ratio. Total debt ratio is total assets minus total equity divided by total assets. So how much is total assets? We're taking this on the back.
6,002.
Right. And total equity. How much is total equity?
$27.42.
Right. So total equity is $27.42. And total equity is made up of common stock. So that's shares, the price of the shares, and what we call here paid in surplus and all retained earnings. That's owner's equity. So we'll have as the answer, total assets of $6,002 minus total equity of $2,742 divided by total assets of $6,002. So that will give you an answer of 54.3%. So you're saying running your business, 54.3% is financed by debt. Go ahead, who has hands raised? I'm not sure who is NL. It doesn't help me, but. If you have a question, go ahead and ask.
Sir, can you go to back again?
Which one? The total
This
debt?
same, yeah, yeah.
All right, so total debt is total assets minus total equity upon total assets. Total assets in 2016 is $6,002. Total equity was $2,742, and that is made up of two figures. You have here common stock and paid in surplus of 300 and retained earnings of 2,442. So that makes up owner's equity or total equity, right? And then you divide that by the total assets of $6,002. And that will give you 54.3%. So you'll say in running your business, it is financed by 54.3% debt. So the other 45.7%, where will you get that from?
That's 54.3 or 0.55?
No, this one goes as a percentage, sorry.
Yeah, sorry, the other half can be financed by equity.
Right, correct. And the two combined, debt and equity, forms what?
Capital structure.
Structured ratio.
Two together forms the capital structure of a company. At I, we're asked to calculate the interest. Sorry, could I move on from total debt ratio?
Yes, sir.
At I, it's the interest earned ratio, which is calculated by taking the earnings before interest and tax and divided by the interest. So where would you get those figures? Earnings before interest and tax and interest, where would you get those? Balance sheet or income statement?
Income
Income
statement.
statement.
All right, so we get that from the income statement. And we're giving it here. Earnings before interest and tax, 813. And the interest paid is 613. So both figures are together and in the manner that we wish. So the numerator of earnings before interest is $813 and the denominator of interest paid is 613. So you'll say that the profits you earn are able to cover interest 1.33 times.
Huh?
And then finally, go ahead.
Sorry.
Okay. And then we go, J, to the cash coverage ratio. So we take the same earnings before interest and tax that we had just now of 813 plus depreciation and divided by interest. So in our example here, depreciation is $490. Right. So it's 813 plus 490 divided by 613, and that will give you 2.13 times. So it's saying this amount of cash you generate can cover the interest that you have to pay 2.13 times. Any questions, comments?
So can you please repeat that one?
So for the cash coverage ratio, is the earnings before interest and tax plus depreciation. So when we add back the depreciation to the earnings before interest and tax, it's an attempt to get close to the actual cash from operating activities. You divide that by interest. So the EBIT would have been 813. EBIT is earnings before interest and tax. 813, the depreciation was 490. You add the two to get a close approximation of what the cash from operating activities was, and then you divide that by the interest, so of 613. So you get 2.13 times. So what this ratio says is that the cash from operating activities would have been able to cover your interest expense 2.13 times. Any questions, comments before we move on to the next topic? No questions? All right, since there are no questions, then we could move on. So in this second segment, we look at future values and present values. So future value is the amount to which an investment will grow after earning interest. So you have money now, you're told that you have X amount of money now, earning Y interest, and it will tell you what the value will be at time Z, right? Present value looks the opposite. So it says the money that you'll have in 5 years' time, given a particular discount factor, this is how much it's going to be valued at today. So remember, the principle remains: $1 today is worth more than $1 tomorrow. So you'll expect that the future cash flow of 1,000 being worth less in today's terms. Right. And you'll understand a little bit more because, of course, say if you have $1,000 that you get in 5 years' time, the reason why we say it's worth less today is because you take into account the interest that it will earn. So to get $1,000 in 5 years, you might only require, and this is just a hypothetical example, you might just require $700 earning maybe 8% for the next 5 years to get to that 1,000, right? In 5 years' time. Any questions? So just to reiterate, right? Future value, right, gives you the amount a current investment will grow to in a future period at a particular interest rate. Current value tells you what a future cash flow will be equivalent to at today, right? So a couple of formulas. Say if you have $100 to calculate the future cash flow, it is that $100 times 1 plus the interest rate, and it raised to the power of the particular time period. I'd encourage you, those of you who have computers, calculators, that you learn the functions on your calculator for your purpose. But since we're doing this virtually, then I'll show you how to do it in Excel so that it could be a little more valued. And so when you get to work, you can actually do it in Excel, which is more like what you will do when you're in the work world, right? So this is maybe one of the advantages of having it to do it virtually. So I can show you in Excel how to calculate future value. Very simple, and removes lots of the headaches that you will have, or you could potentially have, right? So the formula for future value, you take the sum now, you multiply it by 1 plus the interest rate, and raise that to the power of how many periods that is. So for example, if you invest in $100, right, at 2%, at 7% for 2 years, the future value, if we expand it, it's $100 times 1.05 times 1.05, and you'll get $114.49, sorry. Or if we use it in the formula that we were given above, it's $100 times 1 plus 0.07 raised to the second power, and you'll get the same answer. Right. If we were told that it was 5 years, then it would have been, given all the other facts of the figure of this example, if we were told that it was 5 years, then it's $100 times 1 plus 0.07 raised to the 5th power. And that will give you the future value of $100 invested now, how much it would worth in 5 years' time at 7% interest. All right. Any questions? No questions?
No, sir.
Okay.
None at all.
Right, so this graph just essentially shows you how, given different interest rates, if you invest $100 and that interest rate is compounded annually, how it grows exponentially. So it shows you here that there are only interest rates are only different by increments of 5%, but you see the marked difference over a 20-year period. So if you invest $100 starting at year 0, by the time you get to year 20, it might just, at 5% interest, it might just double. But at 10%, it almost triples, and at 15%, it goes almost 16 times. Right. So it's just to show you how it grows exponentially when you use, when you compound it, that same $100 at different interest rates over 20-year period, right? If we go to present values now, so present values use a discount factor times whatever the cash flow is. So the cash flow could be year 1, year 2, year 3, year 4, right? So to get a present value, you use that discount factor. So that discount factor is given by what you might call a hurdle rate or a cost of capital rate times the cash flow that you receive in that particular period. So for example, and the discount factor here is how the discount factor goes. So it's 1 divided by 1 plus R, where R is the rate times the amount of years. And we use this equation to compute the present value of any cash flow. Right. For this discount factor, there's normally a table that is shared. I'll show you how to use that table in a few minutes. So, and it saves you some time from calculations. I'll also show you how to calculate present value using the Excel function. Right. So if we had the same $114.49, so that was the future cash flow, and we say we want it for 2 periods. If we want to calculate the present value at the same 7%, so we have the same factors in the previous example where we work out the future value, but now we're taking the future value and discounting it to present days using, so we're taking a future value, a future cash flow 2 years from now and discounting it to the current day value using the same 7% discount factor, right? So here the interest rate is being used as a discount factor. You'll have 1 divided by 1 plus 0.7 taken to the second power, and you multiply that by the future cash flow, and you'll get what is the present value of that future cash flow. So in some regards, you can see the relationship between a future cash flow and the present value, right? It's kind of the inverse of each other, right? Any questions?
Excuse me, sir. Can you go to back one more time? Sir, can you please go to back one more time?
Right. So in this example, we're told that you have a future cash flow of $114.49. And you expect this cash flow in 2 years' time. You're also told that the discount factor that is being used is 7%, right? So a 7% discount factor over 2 years times a future cash flow of $114.49 will give you a present value of $100. Right. So that is what it says. Let's say if it was the future value of the cash flow was, let's say 3 years from now, the same $114.49, then you would have raised this particular, the denominator to a third power and multiply by 114, and that would give, well, that would have given you what the present value would have been today. Right. Is that
Sir, would the time would ever be less than a year? Would the time given be ever less than a year?
For simplicity purposes, no. No.
Okay.
Yeah, they will count it in periods, right? So they might say quarters. So, but no, it don't ever be less than a year. For simplicity purposes, no. So even if they say it is done per quarter, you'll treat it as 4 quarters if it's a year, right? We'll get into a little more technicality in the next lecture, how that one goes. All right, it's slightly different. Looking at the present value with compounding, again, you see this here is the inverse of what we saw just now. So if you have $100 at 0%, it's a flat line. $100 today is worth just, if we have a discount factor of 5%, $100 today is worth just about $40 in 20 years time, and $100 today is worth just about, use a discount factor of 10%, just about $16, $17. And if we use a discount factor of 15%, then it's worth somewhere about $6.
Sir, does any of these like the value, etc., would it take into account inflation or any other variable?
At this point, when we calculating present values, no, right? The discount factor that we use, well, sorry, that's incorrect. The discount factor that we use will be the factor that that takes into account both inflation and any tax implications.
All right.
Right? Right. So it takes both into account, sorry. But when we get down later and we start doing discounted cash flows, you will see how that is done. Right? So for now, just treat it as is. The discount factor already has taken into account inflation and any tax implications. But good question, Karen. So how do we value an investment opportunity? So whenever we make an investment for cash flow and present value circumstance situation, it is considered time zero, right? And is also considered an outflow. So any investment is considered an outflow, and we say that it occurs, or that initial investment occurs at time zero. There will be other examples as we go deep into the course where you have additional investments being made in subsequent years. But to keep it simple now, and as we'll just add incrementally as we go, we'll treat investments now as time zero. The sale price in 1 year, we call that time one. In the text, they prefer to call it C1. And the example here is that we say we're investing $700 in the cost of a building, and we'll sell it in a year's time for $800,000. Right? So that's the first step. You have the forecast of your cash, the cash flows, investment. Just to repeat, the investment you make is considered an outflow. And when you sell that building, in this case, your investment is in a building. When you sell that building, the monies that you get from that sale is considered an inflow. Right? So step 2, you estimate the opportunity cost of capital. Or remember, the opportunity cost of capital is the best alternative that you have in this, as in this example, to invest the 700,000 that you have now, right? So you could have taken that 700,000 and invested in an equally risky investment in the capital market at 7%. So that will be your cost of capital, your hurdle rate, what you want to call it, right? So that'd be a first. So you estimate the cost, opportunity cost of capital. And then you discount the future cash flows by the opportunity cost of capital. So any investment that happens at time zero will maintain the value, right? So the initial investment, the initial cash outflow of 700,000 will remain 700,000. Because in doing your present value, you estimate in future cash flows and you bringing it back to today's to today's value, which is time zero. So that's what essentially you're doing here. So the 700,000 remains at time zero, and the cash flow of 800,000, you're discounting that to bring it back to time zero. So the 800,000 at 7% would be 1 divided by 0.07, and we've left the 1 outside here, right? Because remember, we're supposed to put whatever t is equal to. What if you put 1 outside the bracket, then it's the same 1. But dividing that, the 800,000, using a 7% discount factor, you get that is equal to 747,664 at today's, that will equal today. So you'll go ahead if the present value of the payoff exceeds the investment. So here, the 800,000 that you'll expect in a year's time, discounted by the factor to today's price, will be equal to 747,664, and you less that from the investment, and you get a net present value of 47,664. This net present value could be interpreted as the value that you add to the company, the value that you add to shareholders. Any questions? Any questions on what I just explained?
Sir, could you explain it one more time?
Good. So in this situation, we're trying to determine whether or not we should undertake an investment, right? Or we're trying to value, right? And we're trying to value this investment, and then we determine whether or not we should undertake it. So the first step is to estimate your cash flows. So your cash flows are of 2 types: outflows and inflows. Outflows represent the investments that you make. Inflows represent the revenue that you will earn, right? Remember, in calculating present value, you're taking all your future cash flows and bringing them back to today's, right? Bringing them back to today's value. So the only element that you have at today's value is the cost of the building that you're selling at 700,000. So that won't change. You now have to estimate how much the revenue of 800,000, which you will get 1 year's time, so which is equal to a future cash flow, how much that future cash flow of 800,000 is equal to today, right? But to understand, or to get how much that is equal up to today, you need to estimate what is the opportunity cost of that 700,000 that you'll invest in. So the opportunity cost of the 700,000 that you invest in, you look for investments that has the same risk profile, and then you use that as a discount factor, right? And typically you look to the capital market to get that opportunity cost of capital. Because instead of buying the building, you could have invested the same 700,000 on the stock market at 7%. Right? So, and get a 7% return, sorry, not invest it and get at 7%, but you could invest the 700,000 and could have gotten a 7% return. So once we've estimated, so the first thing we estimate the cash flows. The second thing we estimate the opportunity cost of capital, or what we call the hurdle rate. And then thirdly, we discount those cash flows, right? So those future cash flows are discounted to today's value. So the 800,000 using a discount factor of 7%, right? So that future value of 800,000 in 1 year's time divided by the discount factor of 7% will give you 747,664. Right? If it was done for 2 years, then you would have taken it. If this 800,000 was coming for 2 years, then you would have taken it up to the second power. I will, at this point, I think it's critical that I introduce. So I'll be swapping between screens. Let me stop sharing this one and share this one. Good. So the table I share here is what we call a present value table. And in the example I showed you just now, you'll say a discount factor of 7%. And then you have the periods here, and these periods are in years. So in the first year, it will be 0.935. So if you had the same 800,000, and you might have some wrong issues, right? So if you had the 800,000 and you multiply it by this factor of 0.935, you'd have gotten 748,000 as the present value, right? So if you learn to use this table, it will be the cash flow, the future cash flow that you expect. You find the opportunity cost of capital percentage here, and then you look for the number of periods going down. So you go across horizontally to find the discount factor, right? Or the opportunity cost of capital or the hurdle rate. And then you use the number of periods. So it's percentage at the top and periods in years coming down horizontally. So for example, now, if we had the same 800,000, but we were expecting it to receive it in 2 years' time, we would have got 7% at 2 years' time, but then would be 0.873. So you would have taken that 800,000 multiplied by 0.873. That will give you 698,400. So you would have invested 700,000, but the future cash flow that you discounted to current day, the future cash flow of 800,000, which you would have expected to receive in 2 years' time now, would have only equaled to 698,400. So in that case, you might have foregone that particular investment. So just to help you with this table again, you look for when you're given a discount factor, generally you'll be given in rounded percentages. You go across the percentages at the top, and then you come down based on the period. So if you have a cash flow, which has been discounted at 9%, in the 14 years time you're receiving that future cash flow, then it becomes 8% at 14 years would be 0.34, and you just multiply it by whatever the future cash flow would be. Any questions on how the table, or another example of how the table could be used?
Good evening, sir. Just asking a question. If we're supposed to use the table, right, as compared to a calculator, we know that the answer is going to be different, right? If you're doing a multiple choice, which one should we use, the calculator or the table figure?
I would use it. I would use this table if you're given it. I would use a table.
Okay,
Because
sir.
you might get slightly different figures because of their rounding. They've rounding. This is round to 3 decimal places. Your computer might go to far more decimal places. Right? I would use a table though. If it was a written exam, but if you, I mean, when you're home and I mean, you get access to everything in reality. So, I mean, because I'll teach you how to do it in Excel. So, which will be a lot more and take a lot more than 3 decimal places into account. So, given the availability of those extra resources, then I would probably use the Excel or a calculator instead of the table. But these tables are normally given in exams. So, but you should see it because in a multiple choice questions, the answer wouldn't be that close. So you will know when there's a wrong issue. So even if you use our calculator and what is in the multiple choice, use this table, then you'll see it. It'll be a couple $1,000 different, but you know, you should be able to decipher quickly because all the other answers would be way off.
Okay, sir. Thank you.
All right. Any questions on using the table?
No, sir.
No, sir.
All right, good. Good. So in this case, once the net present value is positive, then you should go ahead with the investment because it basically says that you're earning more than the opportunity cost of capital, which is 7%, right? And that you're adding value to the company. Good. And this is just the formula for net present value. This is the present value minus the required investment. So that's the present value of the cash flows, cash inflows minus the investment that's required. And that will give you the net present value. This is just a graphical explanation of the example that we just went through. So remember, I told you the investment is done at year 0, and investments are depicted as negative, just to show that's an outflow of 700,000. Then the 800,000 that we expect at year 1 is discounted to present value by taking the 800,000 times the discount rate. That gives you the present value of 747,664. And then the net present value is the difference between the initial investment and the present value of the future cash flow of 800,000. Right? So this is just a graphical depiction of what we just went through. So risk and present value. So the higher the risk, so here 800,000 with a risk of, with a comparable risk of 12% will give you a lower net present value compared to one that is 7%. Right. So that relationship you should know. So the higher the risk, the less the present value. The lower the risk, the higher the present value. So you would understand and you should appreciate that in finance, when the risk is high, investors would want to know that would require a higher rate of return. Right. So the more risks you take, the more returns and more upsides that you'll require. So net present value rule, So you accept investments that have positive net present value because simply they're adding value to the company. So if we had in this example now, so use the original example, we're asking whether or not we should accept this project. So we invested 700,000, but now a comparable investment had a risk of 10%. Should we accept it given the results that we showed here? Any takers? Given the result we have here, should we accept the investment?
Yes, sir.
Oh, no.
I think yes, sir, because the NPV is positive.
Right. So we accept it because there's a positive NPV. So even if it comes down to $10, then we should accept it. That's the basic rule. So once the net present value is positive, you accept the project, right? Because it says that you're earning more than a similar project, you're earning more than a similar risky project or a project with the same risk profile. And then the second rule on the rate of return. So you accept investments that offer rates of return in excess of their opportunity cost of capital. So again, in this example, we're using the same 800,000 and 700,000. We're saying that we're foregoing an investment opportunity that has a return of 12%. But when we look at the project here, and you recognize that this return here is just this doesn't take into account, or what we call a nominal return. This doesn't take into account any discounting. So you just take the cash flow as is, the future cash flow as is, less it from the investment that you make, and you calculate your rate of return, right? So there's no discounting in this example here. You just use the nominal cash flows, no discounted cash flows here. So once this is more than what you, the investment that you would have foregone, then you accept the project or the investment. So calculating present values when there are multiple cash flow. What all of this says is just cash flow in year one plus the rate raised to the whatever power, well, first power. Cash flow in year two raised to the second power, and then you go cash flow in year three raised to the third power, cash flow in year four raised to the fourth power. And then that summarizes this. Well, this is the present value of the cash flows, and then the net present value would be the investment that you make in time zero, and then the sum of all the cash flows that you have, the discounted cash flows for all the periods. That's all what this fancy looking formula says. Any questions? So just to repeat, to calculate the cash present value of all the cash flows here, you take the cash flow in a particular period, you divide it by the discount factor, and then to calculate the net present value, all you're adding, right? So all of this present value of cash flows is in this formula here, right? And then in front of it is the investment that you have made. So it's the sum of all this cash flow minus the investment that you would have made will give you the net present value. And that is the discounted cash flow formula. Here is an example. They've done it slightly differently now. So you take the same 700,000 that you would have invested in year one, but you're getting 30,000 in year two, discounted at 12%. to 30,000 in year 2. In year 1, sorry, discounted at 12% will give you 26,786. You can use the present value table that I get. So you go to 12%, you check year 1, you see what the does factor is, and you multiply it by the cash flow of 30%, and you should get 26,786. In year 2, you expected a cash flow of 870,000. Using that same table again, you could go to the 12%, go down to year 2, get that factor, and you multiply by the future cash flow of 870,000, and you should get $693,559. You add those cash flows, less it from the initial investment you would have made, and then you would have net present value of $20,344. Given the positive net present value, then you should accept the project. Good. So what is left now is just for us to go through some examples. Right, so we're going to spend the rest of the time going through some examples. I'll show you how to do it in Excel. So let's share this first. All right, so the first one asks us to compute some future values. All right, so you have to compute the future values of $100 for the following combination of rates and times. So A, 6% 10 years, B, 6% 20 years, C, 4% 10 years, D, 4% 20 years. Right. So if we use Excel, we open Excel. Let me just share it. So I'll stop sharing the questions and I'll share Excel now. All right, so if we go to Excel, we go to formulas. And then we find, you see my screen, right? Everybody see my screen?
Yes, sir.
Yes, sir.
So you open Excel, you go to formulas, and then you have financials. So under the group financials, you go down to FV. So FV is future value. And then it will bring up a screen like this. So if you read here, it says return rate is the interest rate per period. For example, use 6% divided by 4 for quarterly payments, or 6% if it's annual, if it's the annual, what do they call this? Prime rate, I think. So the first one asks us to calculate the future value of $100 at 6% for 10 years. So we know the rate is 6%, so you go 0.06. It's for 10 years. And currently, we're investing $100, right? So remember when I said we invest, then it is an outflow. So it's minus 100. and that should give you a value of $179, right? So using the formula, it is 6%, 10 years at the future, and it's.
Sir, are we finding FV on the Excel?
So you open it, go to formulas, then financial. So you go to press the formula tab, then you go into the financial group, and then you scroll down to FV.
Okay, thanks.
Right. So just to so that's one way of doing it. The other way of doing it, which was future value would be equal to $100 times bracket 1.06, right? 1 plus 0.06. And then we have this caret, and it is for 10 years, and you should get the same answer, right? So remember, I showed you the formula earlier, which was trying to get back right. So the future value formula that I gave when we started was future value is equal to whatever the dollar is, whatever the amount you need to invest in, times 1 plus the rate raised to whatever power, how many years. So in this different option here, I've given you the $100 times 1 plus the rate raised to whatever power is it, how many years. So you get basically the same answer. So that's the other way of doing it in Excel, right? But I recommend doing the way that I showed first. So you just go to the finance function, find FV, and you insert the numbers. Any questions, comments?
Please call that back. The one with the FV.
So I'll go to the next example, which is principally the same. So in this example, it's for the second question asks you for, it's the same $100 at 6%, but 20 years now. So we go formulas, financial, right? FV. So the rate is 6%. So you go 0.06. It is for 20 years this time. And then the amount that you're investing now is $100. And remember, investment goes as minus. It's minus 100. And then you press OK. So that will give you, something seems wrong. Something is wrong with that one.
Sir, I think you insert one of the figure them in the wrong column. Look where you have 20.
Yeah, it should be the number period, sorry. Right. So NPR is the total number of payment periods in the investment. So that's 20 years, right? So the rate is 6%, the NPR is 20, and then the PV now, the investment that you make is $100. So once you get that, it will give you 320.71. So $100 invested at 6% for 20 years will give you a future value of $320.71.
Sir, can you use the same formula to calculate a loan, for example?
Yeah, but we do it in the next class.
All right.
I'll show you how this calculated. In the next class, we'll do that. If you prefer the way that I did it just now, and the formula that I shared earlier, and you want to slug it out the hard way, then you could go equal 100 multiply by bracket 1 plus 0.06, and then this caret here, you raise it to the power 20, and it should give you the same answer, right? So just round it off, and you end up with the same answer actually, right? Any questions? I'll recommend using the Excel functions though. The fourth one asks us to the fourth questions. Well, C part of question 2, it's 4 years, it's 4%, 10 years. So again, we go back, financials, future value, the rate is 4%, 10 years, and you're investing $100. So that'll be 148.02. If you like it a long way, then it's equal to 100 times bracket 1 plus 0.04 caret 10 years. You'll get back to see it. The D part, I think it raised to 4% for 20 years. So your financial future value, 4%, 20 years, and you invest in 100. And that's what it will look like. So if you invest $100 at 4%, compounded annually for 20 years, you will end up $219, almost double. Well, more than double. Any questions? Once you become comfortable with these formulas, that makes your life so much easier. Any questions? Could we move on to the other one? The question 3.
Yes, sir.
Right. So this one now, we're looking at the present values now. We're calculating present value. So the question asks, what is the present value of $100 received in 10 years time at a discount factor of 1%? So in Excel, again, so this one was, these are future values. And these ones over here would be present values. So same kind of operation. So we're looking $100 discounted at 1% for 10 years. So we go back formulas, financial, and this time we look for PV. This time we look for PV. The rate is 1%, 10 years, and it's $100. So in receiving $100 in 10 years time with a discount factor of 1%, it will be equal to, in today's present value, it will be equal to $90.53. So if we take the same $90.53 and invest it for 10 years at 1%, we should get back 100. Agreed? Do we agree that if we invest this $90.53 for 10 years at 1%, we should get $100?
Yeah.
All right. So just to prove it, we could go financial, present, future value. The rate is 1% for 10 years. And we're investing $90.53. It should give us very close to 100. So, all right. So we see it gives us back 100. Good. Anyhow, so that's just some proof. We go to the next one. So this is the same $100 discounted at 13%, 10 years. So 13% for 10 years. Financial, PV. So it's 13%, 10 years, and $100. So I'll give you 29.46, sorry. We go to C. That's the same $100 for 15 years, but now
Sir, for the one before the 90.753, I have a negative.
yeah, because in the amount of money you invest in, you're not putting a negative sign in the formula. So if I open back my formula here, you see the FV is a minus 100. I'm sure you have it as a plus.
Okay, thanks.
All right, so once you change it to minus, then that's just the way the formula works. So if we go to C, you're trying to establish a present value of $100 with a discount factor of 25% for 15 years. So the discount factor is 25%, 15 years, and it's $100. So you should get $3.52. Right. And now the final one, it's asking for 3 present values. It's asking you for a present value for $100 using discount factor 12% for 1 year, 2 year, for the first year, the second year, and the third year, right? So if we just copy this, 3 years, you're looking for the it's 12%, right? $100 at 12%. So in this one, it's 12%. It's for 1 period. So that should give you 89, 29. And the second one, let's copy it. second one is for, only thing you're going to change is the period. So that's for 2 years. So the percentage remains the same. And then for the third one, it goes, the only thing you change is the period. So that'll be 3 years. And if you add all up together, so that's the present value of the cash flow for the 3 years. So year 1, year 2, year 3. So this would be year 1, year 2, year 3. And this would be the total.
Please go back the one from year 1.
So for the last question, it asks, you're asked present value. What is the present value of $100 received in each of the years 1 through 3 at a discount factor of 12%? You get that?
Yes, sir.
Right. Good. So that's how we work it out here. So it's 12%, 1 period, $100. Here, it's 12%, 2 periods, $100. And here, it's 12%, the third period, $100. And then we total them to get the cash flows, the discounted cash flows for year 1, 2, 3. Any questions? All right. So now we go to the final question for the night. So it's question 4. And it says, Lofting Snodberry is considering investment in a new boring machine. It costs $380 and is expected to produce the following cash flows. And the cost of capital is 12%. So we copy this. So I'm just taking these to Excel just to help us work a little quicker. So you can go here. So year 0, year 1, year 2, year 3, 4, 5, 6, 7, 10. So you can set it up like this. Then we have cash flows. In year 0, we'll make a cash flow, which is the investment. So that is 380, if I recall. And remember that'll be minus, so that's an investment, right? So we could call it investment. And then we get cash inflows. So in year 1, it's 50, year 2, it's 57, year 3, it's 75, year 4, it's 80, year 5 is 85, year 6 is 92, year 7 is 92, year 8 is 80, year 9 is 68, and year 10 is 50. It's happening at, it's 12%. So you could put discount factor, that's the F discount factor at 12%. So here now you want to express what the factor would actually be. So we could use, let me just snip this. So I've pasted the discount factor for 12% period. So we could use this. So there's another way of doing it, right? Anything in period one, in period zero would always be one, right? So 12% in the first discounted first period will be 0.893. So you say 0.893. Period two would be 0.797. Period three would be 0.72712, sorry. Period four would be 0.636. Period five would be 0.567. Period six would be 0.507. Period seven would be 0.452. Period eight will be 0.404. Period nine would be 0.361. And period 10 would be 0.322. So the discounted cash flows, you would just multiply in the case of the investment times the discount factor of 1. And for the inflows, you'll take the cash inflows times the discount factor. And this will give you the discounted cash flows. We just take this formula, we take it right across. That's where we are. And to get the net present value, we just add all of them. So net present value would be equal to the sum of, equal to the sum of all of this. So based on the question, an initial investment of 380,000 with a cash flow profile as described in the question, discounted at 12%, will give you a net present value of 23.75. So given the rule that we encountered earlier, we will undertake this investment. Any questions, comments? Are there any questions or comments?
Yes, sir.
Everyone understands?
Yes, sir.
Okay. So it's pretty straightforward. You calculate the as is right now. It's pretty straightforward. You're given the inflow, the cash flows. You're given the rate, the discount rate. So you can use Excel or you can use the table that we're given, and you multiply that by the those discount factors by the cash flows, and you'll get the discounted cash flow. And you add them all up together, the investment, so all the inflows less the investment, you'll get the net present value. If it's positive, then you undertake the project. All right. So tonight just to recap, tonight we looked at financial ratios in the first segment of the lecture. And in the last segment, we were introduced to calculating present values, future values, and we learned the rules of whether or not we undertake projects. So first, if we have a positive net present value, we undertake the project. And secondly, if our rate of return is higher than the hurdle rate or the opportunity cost of capital, we undertake the project. So that in summary, we're also told, going back to ratios, a couple of categories of ratios we have: short-term solvency ratios, long-term or financial liquidity ratios. We have asset turnover ratios, we have market value ratios, and we have profitability ratios. Those are the main segments, categories, sorry. Any questions? So according to our schedule, we've now completed 2 lectures, so a quiz is due.
Sorry, before you go.
All right. Since some people only come on
What's
Thursday,
coming on the quiz, sir?
so what we would have covered in the first and second lecture.
Sir.
Go ahead.
For the table, right? I didn't get to complete the ending part. Could you please explain the last part, the DCF?
Good. So for the DCF, you'll take the cash flow. So here's the cash flows that is given in the question. Right, so you have all these cash flows is given in the question. And then we use the 12% here, discount factor, and every period represents a year. Similar to here, you see it says year 1, we expect 50. So we go the cash flow of 50 in year 1, we find the discount factor using 12%, so there will be 8.93. So we take that and we multiply the 50 by the 0.893, and we will get the discounted cash flow. And we do that for every year. So if we go to year 4, where we had a cash flow of 80,000, we take the 12%, we come down to year 4, which is 0.636, and it's 80,000 multiplied by 0.636 will give you the discounted cash flow of 50,088. And we do that for every year. Once you would have done that, we get all of these values here. So remember, this one is the initial investment, so that goes as a negative. And then we add all of these figures here, and it will give you this. So what this formula says is the sum of all of these here. And you'll get 2375. Right?
Understood, sir. Thanks.
Right. I have it on the answer sheet, which I will load just now into Edmodo. You'll have a slightly different answer because it worked out in a slightly different, but not.
So sir, next week is the quiz. You're doing it like what, an hour before class?
And some of you see this always be the struggle, because some people on Monday. I'll pause the recording now. Let me just stop the recording.